Hello and welcome to the finale of our summer shorts, where we home in on different areas of treasury management. Today, myself and my colleague Mark Swallow will be discussing liquidity management, something very topical in today's interest rate environment. As always, please use the chat facility on the side if you do have any questions, and we will endeavour to answer these at the end. So without further ado, I'll kick off with a question to all treasury officers. Is your authority holding the optimal level of liquidity? As you will all know, a key factor in running a prudent treasury function is holding enough liquidity. This ensures that the risk of running out of accessible cash is eliminated, and therefore payments are not missed and borrowing funds at higher rates or selling assets at lower prices is avoided. The cash flow shortages seen in March this year emphasise the importance of holding sufficient levels of liquidity. Often, local authorities find themselves sitting on large investment balances due to uncertainty or delays in the capital programme. If this sounds familiar, you are certainly not alone. The current pandemic has heightened this as many projects have been put on hold for the foreseeable future. This will often result in higher investment balances than is necessarily required. However, with bank rates at just 10 basis points, central government debt dipping into negative rates, and money market rates flirting with 0%, it is time to reassess just how much liquid cash is actually required. Despite the Monetary Policy Committee shying away from negative rates at its latest meeting in August, they have not ruled it out as a suitable tool for the future, with support for a reduction in the medium term. The chart on the screen shows gilt yield movements over the past year, where we have seen historic lows, with the shorter end of the curve yielding negative rates, most commonly the 3 and 5 year. Majority of Arlingclose's client base hold their liquid cash in money market funds. Unlike other cash instruments, money market funds are able to take advantage of holding longer dated assets within their portfolio, and this helps boost yields. This is a technique which managers have continued to use, but in recent months, we have seen it become harder and harder to squeeze out the extra basis points. This is shown on the table on the screen, where we compare net returns in March in comparison to August. Holding longer dated assets within the portfolio does mean that there is a lag in reflecting falling yields, which we see here. But now, fund managers are having to lower fees to ensure yields remain in positive territory. So far, this has been working for most fund managers, but we definitely cannot rule out negative net returns going forward. Looking away from money market funds, many banks have also cut rates on call accounts to 0, and short-term local authority deposits are yielding just a couple of basis points. With all of this in mind, one solution would be to invest for the longer term and then borrow short when cash flows require. Of course, a key consideration would be the availability of cost-effective funding at this point in time, which has been a concern due to the uncertainties surrounding the coronavirus-related spending, despite the current overflow of liquidity which we are seeing within the market now. I will now pass on to Mark Swallow, who will discuss how authorities can manage liquidity effectively in the current interest rate environment we find ourselves in.
Thanks, Amar. That was very interesting, and it was interesting to hear how close interest rates are to 0, and the fact that it could be a potential that local authorities are having to pay money to invest in liquid instruments. Liquidity management is something that we've been talking about quite a lot recently. For those of you that follow our insights and read our client updates will be aware that we have written a couple of articles recently about the prospect of negative rates and also about how to manage liquidity. Liquidity is a term that is effectively ensuring that local authorities or organisations have access to cash, and that cash is available to pay current and future obligations as they become due. So as a local authority, you need to ensure that you've got the cash available to pay your staff on a monthly basis, to pay your creditors, and pay other commitments such as capital programme spend. So local authorities are managing liquidity on a regular basis, and they can do that fairly easily because they've got access to liquid cash. Now, liquid cash can come from a number of sources. in the first instance, obviously using your own balance of reserves, which you will have invested in short-term money market instruments. As Amar pointed out, the majority of local authorities invest liquidity in money market funds or call accounts, but as we've seen and as we are seeing, those rates are getting almost zero. Obviously, local authorities can borrow money from either their peers via short-term money markets and local authority markets, or in the last resort can borrow money from the Public Works Loan Board. But as Amar pointed out, a number of things recently have affected liquidity. At the end of the last financial year, there was a liquidity squeeze where local authorities decided to hold on to their sums rather than lending to each other, and so therefore borrowing facilities could either become very expensive or dry up completely. It's unlikely that short-term money market funds would become illiquid, i.e. funds couldn't be converted into cash, but if the money market funds see money being withdrawn, then there's a possibility that they could become illiquid, and that could have a liquidity squeeze. Also, local authorities could have too much working capital tied up, i.e. debtors, stocks, and therefore too little cash available to meet their obligations. Probably wouldn't apply to many local authorities because stocks aren't really a fundamental aspect of a local authority's business. But it could be an issue if you were sort of buying stocks to fund future capital projects, for instance, and therefore your cash is tied up. And ineffective collection and payment policies could also have an impact on your liquidity. So as many of you listening into this are probably treasury managers, you're aware of the terms of cash management, capital management and borrowing facilities. And all of these are fundamental to the liquidity process. Cash management, as you'd expect, provides liquidity through generating cash from your continuous business operations. As local authorities, you have got regular cash flows coming into your organisations. You have fees and charges, although some of these may be under pressure in the recent COVID times. Parking fees, particularly in some local authorities, have been waived completely, so there is pressure on fees and charges there. Local taxation receipts generally are fairly fluid in terms of the way that they flow into your organisation, but they could be under pressure also in the current environment. You also have balances and reserves available to you. Capital programmes, as Amar pointed out, often slip, and therefore borrowing may be taken in advance. So there is another way that you can hold cash or generate cash in your organisation. And the sum of your fees and charges that you receive, or local taxation you receive in advance of being spent, or reserves and balances that you hold, will be invested somewhere. And as we've just been discussing, a lot of that cash is invested at the moment in liquid funds. Working capital management is also fundamental to your cash flow management process. And you can improve your working capital management in a number of ways. You can defer your supplier payments, i.e. pay people later. But again, most local authorities don't find that an acceptable practice and pay their suppliers as quickly as possible, particularly those local suppliers. And again, in the current COVID world, it's probably more acceptable to you as a local authority to pay your local suppliers sooner rather than later. And also you could accelerate the receipt of fees from your taxpayers. But again, it's putting pressure on your council taxpayers or business rate payers, those that are still paying business rates, of course, in the current climate. Is that an acceptable policy for you to follow? So probably working capital can't be improved. And we've talked about borrowing facilities. So as we pointed out, managing liquidity could cost you money. So therefore, the cash that you hold on your balance sheet can be invested longer term to generate better yields. And if you do need to borrow money for liquidity purposes, then you should perhaps consider looking to borrow from local authorities that are still holding surplus cash. The Public Works Loan Board, as we pointed out, is a source of funding for you. But it could be that local authorities generally start to reduce their balances and reserves, and therefore that funding stream starts to dry up. The Public Works Loan Board, they could change the policy, or they are currently thinking about changing their policy, and therefore it might be worthwhile spending time looking at alternatives to traditional sources to protect you against policy change or funding pressures through, you know, the traditional forms of cash that you are able to access. So putting all that into context, as a treasury manager, you're going to try and forecast your cash holdings, and typically treasury managers in both the public and private sector prepare a number of different forecasts. You're all probably familiar with your short-term cash flow forecasts, normally prepared on a 1 month to 3 month basis, sometimes done on a daily and weekly basis, and they're the sort of tools that you use to ascertain what your cash flows are going to be over the next 7 to 30 days and give you an idea of what you really do need for liquidity purposes, because you are spending money in that short term and that's what you need liquidity for. Obviously, you want to have a bit of a longer term view, so you may actually prepare forecasts for a month out to 1 year, but again, you will refine these on a monthly basis because things change and therefore the forecast needs to be changed. And as you're probably aware, for those of you that see our liability benchmarks in our presentations we prepare for you on a regular basis, you can undertake long-term cash flow forecasts, which are basically 1 year to 50 years in length. But as with any forecasts, you know, the weather forecast is a key forecast that changes regularly. The longer time horizon, the more difficult, and the accuracy of forecasts become less useful. So it's very important, whatever forecast you use, if you just focus on short term, or you look at longer term or medium term forecasts, that you regularly update the information that feeds into those forecasts, because without up-to-date information and accurate information, you can't make real decisions about holding optimum levels of cash. As I said, short-term forecasting, this is the key really to liquidity, because it ensures that you have got liquidity to meet those current and future obligations. It gives you the ability to manage your day-to-day liquidity. It makes sure that you don't hold balances in low interest bearing accounts. And as Amar pointed out, those low interest bearing accounts are very low and could actually become interest costing accounts. It gives you some idea if there is a funding requirement, either a short-term funding requirement where you can borrow money from your neighbouring local authorities, or even a longer-term funding requirement where you may want to look to borrow longer term. But it's key for you to making your investment decisions. It gives you an idea of how much money you've got available for the shorter term, how much money you need available in money market funds, how much you can place in call accounts, how much you can place in longer term interest bearing investments. As I said, the medium term forecasting is probably sort of one month, 3 month, 12 month in length, and you will update this forecast based on accounting projections. So when you do budget monitoring, if schemes have slipped or haven't been delivered, then obviously you will reprofile your next month's or next quarter's cash flows. It may be that you decide as an authority to increase a reserve, for instance, in which case you will have an idea that your balance sheet position at the end of March will have a higher figure in it, and therefore your cash will increase, or you may decide to spend money in the reserve, an earmarked reserve, so therefore you'll have less cash available. So these monthly rolling forecasts, they're used for looking at the cash flow impact of changes in working capital requirements. They can be used to inform medium-term investment and borrowing decisions. You can use your cash flow forecast to help you manage your budget monitoring process, and also, you know, helps you look at the capital program. If you're a cash manager and you've got details of a capital program, and every month you're having to reprofile your forecast because the capital program hasn't been delivered, then really you need to be talking to the capital funding departments to ascertain when they feel that they are going to spend that money. Because, you know, if you are holding money very short term because you're expecting it to be spent on a project and it's not going to be delivered, then ideally you want to know that sooner rather than later, particularly if it's costing you money to hold cash in short term investments. And longer term forecasting, this is the graph below is something that you probably are familiar with. It's our liability benchmark graph, but it's, as you'll see, it's a forecast that goes out to 50 years in length, and it looks at the capital financing requirements, the borrowing, the maturity profile of the borrowing, and predicts the borrowing need. But this is more a strategic planning forecast and gives the organisation a view of what its long-term investment or long-term borrowing decisions are, and links that to longer-term interest rate forecasts. So really, from a liquidity point of view, it's more crucial that you get the short-term forecasts as up to date as possible, but you refine those on a medium-term basis, and this longer-term forecast is more attuned to longer-term strategic treasury decisions. So summing up, liquidity management, as we've said in a number of our publications and we've said in today's webcast, is key, we feel, in this current interest rate environment. As rates get to zero and potentially get into negative territory, holding liquidity is an expensive luxury. Good cash flow forecasting is vital. Liquidity management can't be undertaken if you haven't got good cash flow forecast in place. It's vital, if you're the treasury manager and you prepare the cash flow forecast, that you have a good relationship with your capital teams, your treasury team, the exchequer services functions, because without that information and without updates to the information in your forecast, you can't fine tune it. As I said in the previous slides, we feel that it's probably very important for you to have a short to medium term forecast for liquidity purposes, but also the long term forecast is vital, because if you have got a borrowing need in the future and you decide from a strategic point of view to take borrowing in advance of need, then that's going to increase your liquidity buffer, isn't it? So it's key to link all three of those forecasts together and keep updating those. But it's key to not always think of liquidity as having access to cash. It's looking at our the information that our clients provide us on a regular basis. Many local authorities feel liquidity is holding liquid investments, but obviously having access to short-term borrowing facilities when you need them is just as crucial to managing liquidity as it is to having money available in short-term investments. So we hope this webcast has been informative, and it hopes to give you a flavour of the sort of things that you should be thinking about as organisations to ensure that you are able to be liquid and therefore run your services on a day-to-day basis, but in a position where actually holding liquidity is costing you money that you don't necessarily need to be paying out. So if you have any questions, then we can answer those. We hope you've enjoyed our series of short webcasts over the summer period.